Workers' compensation was actually the first type of social insurance developed widely in the United States. Let's take a look at workers' compensation. Workers' compensation is a social insurance program that provides cash benefits and medical care to workers when they suffer injuries or illnesses related to their employment. In 1911, the state of Wisconsin established the first workers' compensation program that was not declared unconstitutional. All 50 states, as well as the District of Columbia, Puerto Rico, and the Virgin Islands, have some type of workers' compensation programs, though Texas and Oklahoma permit employers to opt out of workers' compensation insurance programs. Typically, workers' compensation provides cash benefits and medical care to employees when they suffer injuries or illnesses related to their employment. It also provides survivor benefits to dependents of workers who die due to work-related incidents. Workers who receive these benefits are not permitted to sue their employers for damages of any type. The federal government has its own program and also administers the Longshore and Harbor Workers' Compensation Act, which covers all longshore and harbor workers in the United States. The federal government has no involvement in the administration or financing of workers' compensation programs, nor does it have reporting requirements or standards for determining what constitutes a tax-qualified plan. Thus, information about actual costs of workers' compensation and the number of workers covered under the various states and U.S. territory plans is not readily available. Workers' compensation begins paying for an employee's medical care immediately after a workplace injury occurs. After a waiting period of 3 to 7 days, it pays temporary disability benefits, and it pays permanent partial and permanent total disabilities to workers with permanent disabilities caused by their work. Other costs covered include rehabilitation and training for employees who cannot return to their pre-injury jobs, and benefits to survivors of employees whose work-related injuries lead to death. Employer costs for workers' compensation include insurance premiums and deductibles that have to be met. If an employer is self-insured, meaning the employer funds the workers' compensation plan rather than buying insurance from a provider, the costs of the plan equal the administrative costs related to it plus any benefits paid out to employees. Employers can reduce their share of these costs by focusing on strategies such as educating employees about wellness and safety, ensuring that the workplace is free from hazards that could lead to injuries or illnesses, establishing return-to-work programs to get employees back to the job faster, and doing a better job of tracking claims to identify where health and safety problems are in their organization.